Hey guys, first of all, ask questions and subscribe. Today we're gonna go into basic risk management, how not to get wrecked, and how to play stop losses and stuff, you know. What is risk management? Trading is a high risk occupation that is 100% based on probabilities. Even the best traders will go on loss streaks due to variance. Managing your risk is the only way to survive. Here's a little example of, one bad trade I did. I did end up, closing it in profit, but yeah, whatever. A stop loss is a risk management tool that kills your order at a certain price. You set to limit to the downside risk. Example, long 1, target 1.5, stop loss 0.8. You do not want to be swimming underwater like this. But the thing is, where do you place the stops? And when to do it. And also, this was still FTX, at a very different price. Been a while. Anyway, stop loss placement, the most crucial part of using a stop losses, with no real answer but only educated guesses. Too close to price and you risk getting wigged out. Too far from price and you risk too large a loss for risk given. No stop loss and you risk a flash crash or opposite. Like you long it here, for example, this bottom looks very nice. You long it, runs these stops over here and, then they crash it. And, some people might have stops over here, when in their shorts and they get stopped out over there. And that's basically how the market works. Too tight of a stop loss. Stop loss at the high. This is your short entry and this is what you're targeting. And the thing is, like, they just wig you out over here before going to your take profit. And that's basically the pain of trading, Stop loss at the high, your short entry, your target, and you should have gotten out over here. And but sometimes you're good if you got out over here, and you can play the same trick over there again. How to spot entries, has been talked about in previous videos. Make sure to watch those as well, and make sure to ask questions because we love those. Why stop losses? Too wide of a stop loss is usually okay, although you need to be realistic about expectations risk reward wise. Unless you were trading illiquid low cap coins, it's difficult to target 10-to-1 risk reward trades. Smaller risk to reward trades are better for wider stops. High risk of slippage with wide stops. And especially if you trade illiquid shit coins, or quarterly futures. I love my quarterly futures. Why I love them, I will probably explain in later videos. And here, nice example of a trade you would like to want, place your stop here a little bit wider and target is these highs, of course. And then, this happens. No stop losses. No stop losses, risk incredibly high, have to babysit positions, have to keep strict self-control, risk management. Black swan will ruin you under certain circumstances, but you won't get wigged out in a stop liquidation run. Guys, I am sure there will always be a black swan event. It's just a matter of when. I've been in this space for quite a while, and there will always be another black swan event. And when it comes to getting wigged out of trades, I love to use stop losses on the index price. That's basically the index price is made up out of a bucket of spot exchanges, and they don't wick as hard, as of course perps, because perps run stops and then you get a lot of selling at bottoms, which you don't really have on spot exchanges. Here, if you're a spot trader, you can easily trade this based on spot. You won't get stopped out at bottoms, you can hold through them. But you need to keep staying active. We can do a couple of slides into trading tilted. Let's see how far we get. You know, like you enter along over here, your target is there, you want to retest over there. This is it, doesn't reach your target, you get stopped out. Quite a leg down, and you're like, you know, you don't see a bounce, you see lower highs, so you try to go for a short over here. And what happens to that short? Well, you get stopped out over here already. And but yeah, they don't really make new highs either. They go down further. And so you try to, basically you still see lower highs, right? So you go for a next short over here. And did reach this one, but they stop you out here as well. So you go for a long, you know. They stop you out here as well. And then you go for a short again, stop you out here as well. Then you go for another short, and they stop you out here as well. And you know, trading like that, and you know, over here it basically reaches your original long entry again. So sometimes, you know, it's really easy to tilt it. This is just some examples. And yeah, sometimes it's just better to take a few days off or wait a bit. This is price action for quite a longer time period. I think this is 3 months or something, 4 months. But still, you know, yeah, it's hard. Make sure you watch your previous videos. It goes into how to spot certain trades, how to choose a direction, stuff like that. But yeah, it's easy to tilt and to ruin your account, trading account. And yeah, capital protection is basically the most important thing there is. So see you guys again soon. Make sure to ask questions and subscribe.